Good morning, good morning, good morning. My name is Dr. James M. Moulton Jr. I was born in Miami, grew up in Dallas, joined the Army at 18. When I was in the Army, I had the opportunity to become a budgeting officer, which got me interested in finance. I exited the military in 2005 after serving in Iraq. And then I started my career as a college professor slash financial planner. I've been doing it since 2005. I am now the program director over the Masters of Science of Financial Planning at the American College of Financial Services located in Pennsylvania, although I am in Texas and I work remotely. I'm excited about being here today, so let's get started. Next slide. This is our agenda. We're going to talk about updating your budget, that is known as the B word. Talk about the importance of saving early. Talk about paying down debt, strengthening your credit, and how to get started. And then we'll follow this with a Q&A session. Next slide, please. First of all, let's talk about updating your budget and why it matters. It matters because a budget ensures that every dollar has a job. It informs you how much you can afford on a home based on your lifestyle. But let's get a little deeper. We know we are here to talk about home ownership, but we do not want to be house poor when we get this home. What does that mean? I know you probably heard that, being house poor. So house poor is the concept where everything that you make, you spend it on a house. So you do not have any excess cash or financial resources to do anything else. How do we budget? We estimate how much we're probably going to spend on something. We write it down in one column, and then we do the actual, and then we look at the differences between what we thought we were going to spend versus the actual, and then we make adjustments from there. A budget is very important. We shy away from the B word, but the B word is a good word when it comes to budgeting. Next slide. Strategies for success. Start by tracking your spending for a month. This is easier now than it used to be because you can automate everything. So Mint, you need a budget. You put it in Mint. Be prepared to make adjustments as needed. As I stated, we put what we thought we were going to spend, what we spent, and then we make adjustments as needed. Every dollar counts. A lot of times we think, I just spent $2 on this soda at the register, or I spent a few pennies on this, but every dollar counts. But reduce your big fixed expenses will have more impact. Let me give you an example of that. I have Hulu. I have Hulu Live. I have Hulu on every screen in the world. Then I have some premium add-ons. That's a fixed expense to me. So what I can do is I can just say, you know what? Let me take some of this stuff off. I'm not watching shows on this channel. I also have Netflix, so I can reduce that expense. And we also should follow the 50-30-20 rule. What is that, you ask? 50% of income goes on needs, 30% on wants, and 20% on savings and debt repayment. So the 50-30-20 rule is a good rule of thumb to follow. Next slide, please. Start saving early. There's many studies. People do papers on this about how you can start saving in your 20s. And by saving in your 20s, you can put more money in when you're in your 30s, and you still will have more money if you just started a lot earlier. Upfront costs add up. You have a down payment, closing costs, moving expenses. Unless you have a big family that's willing to move you for free, moving expenses come into play. Need to maintain a long-term savings for maintenance. That is very important, long-term savings for maintenance. Next slide, please. Start building an emergency fund. The previous slide said long-term savings for maintenance. An emergency fund is 3 to 6 months living expenses. Some people look at their gross income. Some people look at their net income. What I like to do is see how much it costs me to live per month. Okay, if it costs $2,000 to live, that includes my mortgage, that includes all my bills, everything that's mandatory. And I say, you know what, let me multiply that by 6. or 3 at the start. First, I start with 1 month, then I get 2 months, build up to 6 months. And why is emergency fund? And why am I spending more time on that one line? Because an emergency fund is what it means. It's for an emergency. If your car breaks down, what we usually do is we go to our credit cards, which increases our debt. We have an emergency fund built up. We go into our emergency fund, pay for the car repairs, save up a few more months and put it back. Set a savings goal for home ownership. Be specific and write it down. When we talk about goals, we have to have SMART goals. S-M-A-R-T. Specific, measurable, attainable, realistic, and time-bound. Turn unexpected money into savings. We know we got stimulus checks. We got them from President Trump, and we got them from President Biden. This is not a political conversation, but both of those presidents gave us stimulus checks. Those are automatic savings. We could put them in our savings account. And then another thing, automate, automate, automate. Make it automatic to put money away. When I was in the military, we had something called an allotment. We would take an allotment from our check and go into another account. But in the civilian sector, there's many ways you can save. Just automate, automate, automate it. Make savings automatic, and then you don't have to worry about it. Next slide. Pay down debt. Why does it matter? We have heard of debt to income ratio. There's usually a requirement, 43% or below of your gross income.
Now get this, buyers who shop their loans.
I have some feedback from, okay. Total debt, the debt ratio will determine how much you can borrow. So you need the general rule of thumb is 43% or below. Lower debt equals higher credit score. Can help you get approved for a lower rate loan. Credit score is typically should range between 620 and 640 for mortgage approval. The higher your score, the more money you will save when financing. So get your debt down so you can have a better debt to income ratio. Next slide. Before applying for a mortgage, pay down credit card balances. Avoid applying for new credit before and while you're buying a home. I've purchased a few homes in my life, especially when I got the military. And they would always tell you, they being a real estate agent, if they're a good agent, would say, hey, do not make any big purchases. Matter of fact, do not even put anything new on your credit card when you're applying for this loan, because you just increase your debt. Consider refinancing revolving debt like auto loans, get a lower rate, helps you out. Then there's two methods they want to talk about. We'll talk about the avalanche method or the snowball method. Most of you have heard of the snowball method, which means you put your credit card debt or your debts all side by side and say, I'm going to start on the lowest one first. Then I'll pay that down and then pay that off, and then I'll go to the next one. You still pay all your other debt on time in the correct amounts. But if you start the lowest one, and then once you pay that off, the money that you were paying on the lowest one, you can put that towards the next one, and it just snowballs and it motivates you. I paid this card off, now I'll pay the next one off. Or the avalanche method is when you pay the highest, the one with the highest interest rate first, because you'll save longer on the financing cost of that debt. You have the snowball method and you have the avalanche method. Whatever method you choose, do something. Next slide. Strengthen your credit score. Clean credit history and a strong score will improve your chances for approval. The higher your credit score, the more and better options you will have. Why does this credit score matter? Why is this Fair Isaac, all this FICO score, and all these 3 credit agencies? Why does it matter in the long run? Because it gives them an indication of our likelihood to continue to pay these mortgage payments. Increases the likelihood for them to continue to for us to pay the mortgage. So that's why it matters. Whether we agree with it or not, that is something that's been put in place. It helps people gauge our character, credit worthiness, and whether we'll pay the loan back. So that's important for them. So that's why it exists. Next slide. Strategies for this: pay your bills on time and in full each month. I know that in full each month is a big thing. Keep your balances at or below 30% of your limits. If you have a $100 limit, Keep it at $30 max of on that card. Request a copy of your credit report and review for accuracy. If errors exist, dispute or resolve with the creditor. Pay off past due accounts that you owe, especially within the last 3 years. Your credit history, your payments, this payment amount, the fact you pay it on time is the biggest percent of your credit score. It's 35% of your credit score is if you're paying your debt on time. And that's why when you stop paying or you go 30 days delinquent, 60 days delinquent, 90 days delinquent, your credit score drops drastically and you're like, what is going on? So it's important to do that. Total debt, the amount of debt is 30%. So you can see paying it on time is 35%, the amount that you have. So that's why we try to get below the 30% amount of all of our credit. You should use annualcreditreport.com to access a free credit report. I know there's other things out there like Credit Karma, but the government is authorized annualcreditreport.com is the only one that the government pushes, and it's free. It's totally free. And it's 3 credit reporting agencies. You can actually get 3 if you do, one each time. But what I like to do is when I go to annualcreditreport.com, what I do is I just request all of them from all 3 agencies. Sometimes the scores are slightly different depending on which reporting agency. And I like to reconcile my credit report that way. Next slide. Before starting out, ask yourself, what's my budget for monthly mortgage payments? First of all, we have to do a budget. See where our money's going, see where we can make changes, and then see what we can afford. Start with online calculators. I actually like going to bankrate.com. That has a whole lot of online calculators that are free to use. How much do I still need to save and when? What does your down payment have to be? And you can divide that over the amount of disposable income that you found in your budget and figure out how much how much you still have to save and the way you can save it. How's my credit? Go to annualcreditreport.com, look at it, figure it out, see what your credit looks like and see where you can clean up. Because sometimes there are mistakes that are hurting us that we don't even know about. So if we would clean up those mistakes, we would be good overall. What's my current debt load? What are my needs, wants in a home? And where do I want to live? Because we understand the most important concept in real estate is location, location, location. So that's what we do. We figure out where we want to live. That dictates how much we're paying for the houses. Can I qualify for any special programs? As I stated when I introduced myself, I know it's a brief introduction, but I wanted to get into the meat of the presentation because this is not about me, it's about the presentation. But being in the Army, I get access to VA loans. So what can I qualify for any special programs? That is important to find out. A lot of times your agent, Habitat for Humanity's headquarters, they can help you out and figure out if there's anything that you can qualify for. Any questions? I wanted to leave more time for questions, so next slide, please. I am waiting to see what's in the chat so I can see what questions that you guys may have given to me. I'm doing a home and Habitat now. How do I figure out the best budget around a possible mortgage? The best budget? First of all, let's just get started on budgeting. Start, like I said, write down what you're spending for a week and look at that. Everything you spend. Everything you spend. A lot of times we ignore small things, but those small things add up. The best way to clean your credit report. That is another good question. Go to annualcreditreport.com first, and let's get this stuff printed out. It's free. I don't have to pay for a service. Let's get on this to see what the mistakes are. First, let's look for mistakes because sometimes there are mistakes, and that helps your credit greatly by getting those mistakes. And a lot of times you have to write the credit. You have to write to the credit bureau. And I'm not promoting Credit Karma, but I know people that has that, and they can dispute it right on the app. So there are apps out here that you can use that you can make a dispute right then. It's a question: when you use Credit Karma, does your credit score drop? That is a good question. I'm not a Credit Karma expert, but it shouldn't drop when you use a credit app, that's just finding your credit. A lot of time we have hard credit inquiries. You go to a lot of car dealerships, you go to a lot of home places, and you're applying for multiple credit cards. That's when you really have a lot of credit card drops, or credit score drops on that. I had a question on using a credit repair good. Can you go over somebody asked me to go over the 50, 30, 20 rule. I know I was going fast. Let me do that one first. 50% of your income goes on needs. So needs first. So we break our income down into 100%. We say 50% goes on my needs. Then 30% goes on your wants, because we know we live with needs and wants. And then you do 20% on savings and debt repayment. I like to flip it around and go to 20, 30, 50, because I want to 20, 50, 30, so we have to kind of go down, make sense, it makes it look better. But first of all, let me take 20% of my income out of this picture for savings and debt repayment, and then start from there and see what I do. Then I look at my needs, because I have to figure out how to get this savings under control, and I have to get this debt under control. And then I worry about the 50% on needs, because we know we're gonna take care of our needs anyway. But let me go ahead and get used to saving first. What is helpful to build your credit when you do not have credit yet? That is a great question. I helped my daughter build her credit. I was got a credit card in both of our names, and it was a $500 limit. And so it was like baby steps. Use it to buy books because she was in college, and then we'll pay that off each month, and it built her credit score up. Or I added her to her car loan. She didn't have credit at all. Put her on the application, use us, with her Social Security, paid the car off, that built her credit. So the better way than those two, if you don't have a person that help you build your credit, is to get what's called a secured credit card, which is kind of like a prepaid card, but it acts like a credit card where you give money to the bank. So you might say, I want a $200 secured credit card. It's secured by the money that you're using. So you put the money on the card, you charge it, and then you keep putting the money back. So that's another way to do it, prepaid. That's another way to do it. How much does it affect your, if you choose to close a credit? Affects you if you choose to close a credit card. Okay, let's talk about this closing. It does affect you when you close a credit card. But let's talk about why. If we talk about the why, it kind of makes sense. There's something called a credit utilization rate. So say if I have two credit cards and they're both $100 each. I told you earlier that we should have no more than 30% utilization, right? So I have $200 that I can use. So that means $60 is my 30%. If we did $100, it'd be $30. Okay, so let's talk about that. Okay, now I had $60 I can use. I just closed a credit card account. How much do I have access to now? I have access to only $100. I used to have $200 access, but if I still had that $60 charged, now my credit utilization is a lot higher. I'm using more of my available credit. So when you close a card, you're getting rid of the possibility and the amount of credit that you qualify for. So it's the best to get a credit card to help your score go up. Well, the short answer to that question, first of all, what's your credit score and how are you dealing with credit anyway? Because you're saying, well, get another card and to increase your utilization rate.